Welcome everyone. Today we're stepping into an important checkpoint in the accounting process, the trial balance. Think of it like a financial double check before we move on to preparing full financial statements. You've already learned how transactions are first recorded in the journal and then sorted into ledgers. But how do we know everything has been recorded correctly and the balances out? That's where the trial balance comes in. It helps us spot mistakes, ensures our debits and credits match, and gives us confidence that we are ready to prepare accurate income statements and balance sheets. By the end of today's lesson, you will not only know what a trial balance is and why it is important, but you will also be able to prepare one yourself from ledger accounts, spot common errors, and learn how to fix them, just like a real bookkeeper. Let's get started. By the end of this session, you will be able to learn these topics: define what a trial balance is, explain the purposes and importance of a trial balance in accounting, identify the position of the trial balance within the accounting cycle, describe the relationship between the journal, ledger, trial balance, and financial statements. Prepare a trial balance using information from ledger accounts. Recognize common types of errors found in a trial balance. Apply methods to identify and correct trial balance errors. Accounting is practiced under the time period assumption, which allows the ongoing activities of a business to be divided up into periods of a year, quarter, month, or other incremental of time. The accounting process is cyclical. A cycle is a period of time in which a series of accounting activities are performed. Once the current cycle is completed, the same recording and reporting activities are then repeated in the next period of time equal length. There are about 8 steps in the accounting cycle. Step 1 to 4 are core bookkeeping tasks, including identifying, recording transactions in a journal, posting to the general ledger, preparing an adjusted trial balance. Steps 5 to 8 involve adjustments, preparation, and closing tasks, typically requiring an accountant's expertise. Today we are at step 4, extracting ledger to an adjusted trial balance. First of all, what are trial balances? A trial balance is an internal accounting report that lists all the balances of a company's general ledger accounts, including cash, assets, liabilities, equity, income, and expenses, those big categories, at a specific point in time, ensuring that total debits equal total credit. Thus can be used to check for errors and verify the accuracy of the double entry bookkeeping system. So this tells the primary purpose of a trial balance is to ensure that the sum of all debit balances equals the sum of all credit balances in the general ledger, which is a fundamental principle of double entry accounting. It is prepared to test the arithmetic accuracy of ledger accounts before preparing financial statements. A trial balance may be generated at any time to test whether a total debit equals to total credit. In accounting, journalizing and posting transactions to the ledgers are done every day in the cycle. Financial statements are typically prepared only on the last day of the cycle. Why is it called trial balance? The balance is important. A trial balance helps identify potential errors in the accounting records, such as missed entries, typos, or misclassifications before preparing financial statements, such as income statements and balance sheet. So the balance means the total of all the debit balances in a company's ledger accounts must always equal the total of all the credit balances. It's simply a worksheet to check for accuracy before preparing financial statements. If both of the total columns do not equal, there is an error or errors that must be found and corrected. It is a way to test or check that everything has been recorded correctly. Every transaction in accounting must have equal debit and credit sides. If the total of debit and credit sides in the trial balance are equal, it means the records might be correct. If they are not equal, it shows there is an error that needs to be found and fixed. A trial balance is an internal document used by accountants and auditors to check for errors and ensure the accuracy of the bookkeeping system, not an official financial statement that are given to the external users to look at. This table tells how often these accounting activities need to be taken place. Daily tasks include recording transactions and updating ledgers. End-of-month tasks are financial reports and closing the books. It is a mixture of thinking, analyzing, and deciding what to do, copying, transferring info from one place to another, and calculating totals, balances, and results. A trial balance usually prepared at the end of an accounting period is quite important. It is the last step before preparing the final financial statements. This figure shows the flow of accounting records leading to financial statements. It's part of the accounting cycle. We have studied some of the topics already, including journal and ledger. Journals, also called books of original entry. All business transactions are first recorded here in chronological order on daily basis. Each entry includes date, accounts affected, debit and credit accounts. Ledger we also studied are information from journals when they are posted to ledger, which organized transactions by accounts, such as cash ledger, sales ledger, rent ledger, and so on. Each ledger shows the cumulative balance of an account. After ledger, it will be trial balance, which is what we are studying today. Trial balance is a list of all ledger accounts and their total balances at a point in time. It used to check if total debits equals to total credit, help catch errors before preparing financial statements. Next step after trial balance, normally there will be an adjustment, and when adjusted trial balance is completed, financial statements can be produced. They are based on trial balance. There are mainly three types: income statements, balance sheet, and cash flow statements, which we will study later on. So in short, the relationship of these different accounts documents are journal, ledger, trial balance, and financial statements. To go further, this table gives a side-by-side overview of the differences between the journal, ledger, trial balance. The comparison is based on a couple of criteria including meaning, what is it, record, process, balance required, narration, debit and credit format, used for, and type of book. For example, process. Writing in the journal is called journalizing, while moving journal entries to ledger is called posting. Another one, how transactions are recorded. In the journal, transactions are recorded sequentially as they occur. In the ledger, entries are recorded account-wise, one ledger per account, such as cash ledger, rent ledger, expenses ledger, stock ledger, and so on. Debit and credit format. The journal uses columns to show debits and credits. The ledger shows sides: left equal debit, right equal credit. In terms of balancing, a journal does not need to balance. Total debits and credits are unchecked here, but a ledger account must be balanced to determine account total. When it comes to trial balance, debit must equal credits. These are total debits equals total credits. This is a standard structure of a trial balance, showing a list of accounts, their numbers, and debit and credit totals are balanced. 60,500 equal. The fact that the total balance means the bookkeeping is mathematically correct, but it doesn't guarantee there are no errors in classification. For example, if two errors are cancelled each other, you might get a correct answer at the bottom of this accounting table. Therefore, there are two errors in the middle of the calculation, so they still need to be checked. Remember the example we studied in lesson 5. Here is the explanation of this example again. One is to record transactions in the journal. On the left-hand side, there are 5 transactions. The other one is the cash ledger only posted from the general cash accounts. There are 5 cash accounts altogether, and the total after calculation is 7,000 debit. So this can be calculated by adding total debits, then add total credit. Total debit minus total credit, and whichever is the biggest will be recorded on the correct side of it. In this case, the debit side is bigger than the credit side, therefore we record 7,000 in the debit side. The ledger shows the credit ledger helps track all cash movements. In this case, 5 cash movements. There are in and outs. The ending balance shows how much cash is currently available left in the bank account. Every journal entry that affects cash gets posted here, either as a debit, cash in, or as a credit, cash out. These two tables show how ledger balances are summarized and translated into a trial balance account. On the left, we see individual ledger accounts with debit and credit entries. On the right, we see how these are summarized into trial balance. Trial balance check the total debits and credit, and they need to be equal. There are 6 ledgers in the ledger table. This checks that the books are balanced before preparing financial statements. The cash ledger has 3 entries, all in the debit side. Therefore, the total of cash ledger is on the debit side is 15,500. The 3 cash entries can be combined because they all relate to cash transactions. Instead of listing multiple cash transactions separately, you can summarize them into a single entry. All the other ledgers, including, for example, account receivable, equipment, office supplies, service revenue, utility, they are all single ledger, means once only in the trial balance. You total up the final balance of each ledger, then copy the total from the ledger, place each balance into the correct place, debit or credit, in the trial balance table. This process checks the accuracy. You can see from the matching colors that shows the movement of the account in the ledgers into the accounts in the trial balance. After putting all accounts into the trial balance, you can do the calculation and identify if debits and credits are equal or not. In this case, they're equal. To summarize how to posting ledgers to trial balance, this slide shows how to summarize balances from individual ledgers and transfer them into a trial balance table, which is a key step in the accounting cycle. In this table, there are 4 ledgers, including cash, fee earned, common stock, and supplies expenses. The table shows different figures of these different ledgers. So the key rules: in the trial balance, only the total account balance are recorded from the ledger. This could be either debit or credit balance, depending on the total outcome. All total debits equal total credit because of double entry principle. The balances, if balance brought forward is on the debit side, it is called debit balance and is showing in the debit column of the trial balance. If the balance brought forward is on the credit side, it is called the credit balance and is showing in the trial balance in the credit column. The following accounts will always have debit balances brought forward, including all assets. For example, computer, motor vehicles, buildings, bank accounts, or cash. All expenses accounts such as rent, electricity. All drawing account. All purchases account. Return invoice accounts. The following accounts will always have credit balances brought forward, including capital account, all liability accounts, sales account, and all other incomes, returns outward. So here I have one question. Is the agreement of trial balance conclusive proof of accuracy? The answers is showing here. Through the trial balance, it helps to identify the balance and the arithmetic accuracy of the book of accounts. It is possible only when the account has not committed any errors, they would be balanced. But out of the errors made, there are possibilities that they can disclose any disagreement of trial balance, and even the trial balance may agree without disclosing certain errors made. Hence, the trial balance is not regarded as a conclusive proof of correctness of books of accounts maintained. There are many ways that trial balance can make errors, and there are certain ways to address those problems if the real problems could not even be identified. So here summarizes different types of errors. Errors of trial balance refer to mistakes made when compiling a trial balance in accounting, which can include issues like incorrect account balances, transposition errors, omission of entries, posting wrong accounts, calculation errors, and errors in principle where accounting rules are not followed properly or legally. Also, not all errors will be detected by a trial balance. Type of errors are error of omission. These are transactions take place but not recorded. Errors of principle. Those are accounting entries recorded in the wrong place. For example, using single entry, casting error, and traction error, two entries on one side, and so on. Errors of commission accounts recorded correctly, debit and credit, but to the wrong subsidiary account or ledger. Compensating error are those accounting error that offsets another accounting error. Like I mentioned earlier, two errors make it right. For example, the wage expense could be too high by 2,000 due to one error, while the cost of goods sold could be too low by 2,000, exactly the same amount due to a compensation error. And then it can be quite difficult to spot after finishing the trial balance. The concept of suspense account. If all the efforts made to locate the errors fail, trial balance may be temporarily be balanced by transferring the amount to suspense account. So suspense account is kind of a man-made account be put at the shorter side. For example, if credit total is higher, suspense account will have debit balance, and if debit total is higher, suspense account will have a credit balance. Here to have a summary of the steps to make trial balance using ledger accounts. To summarize, step 1, identify the account names. So to each, debit and credit. And step 2, identify normal balance, which is debit and credit normal balance that we have studied in lesson 3. I copy the table here to repeat the formula I give to you to help you remember which side should have debit and which side should have credit as normal balance. Step 3, put the trial balance in correct categories using the sequence. So asset at first, liability second, and equity afterwards. Equity could include capital equity and dividends or drawings, which are negative equity. And number 4, revenue or income. And number 5, expenses. Step 4 would be calculate debit and credit totals and add up all the debit amounts and all the credit amount from the list of account. Step 5 is the step to check the balance. The total debits should equal total credit. If they don't, there is an error or some errors somewhere. Even though they are balanced, there is still possibility that there are errors occurring in the process. Here is an example and can be done as an exercise. It's OTE company. The company has got a couple of transactions in January 2019, starting from January 1st, starting the business with £6,000 in the bank injected by the owner. Each entry describes what happens on a specific date, such as starting the business, buying equipment, or paying off debts. These are raw transaction descriptions. They have not yet been recorded in journal or ledger yet. So students can do the first exercise to record those transactions into journals using double entry bookkeeping principle. This is to practice translating business activities into accounting records. It includes various types of transactions and understand the different terms of account names. The second one would be the journal, which is completed and showing here. This shows how each transaction from the first slide is recorded in this journal table, which is the book of original entry. Each row includes the date, description, accounts involved, and the debit and credit amounts. It's very careful, need to not make any mistake because there will be very difficult process to identify those mistakes. For each row includes all different descriptions need to be read accurately. For example, when equipment is purchased, equipment is debited and cash is credited. This step is essential because journal serves as the starting point before amounts are posted to the ledger. It needs to be accurate and needs to remember the principle that every transaction affecting at least two accounts according to the double entry principle. This is a slide showing the ledgers of the journals, summarized accounts basically. Moving forward, we have got the 5 individual ledgers for the main accounts summarized in the journal. Ledgers show all movements within one account and help calculate the ending balance. These 5 accounts summarize all the transactions in the journal. For example, the cash ledger shows cash coming in as debit and going out as credit, with a final balance of 2,500, which is on the debit side. This is the stage where students can work on this step in order to organize and understand the process from moving journal information to ledger table. Finally, we come to trial balance, which is what we study for today. This final slide shows the trial balance, which summarizes the ending balances of each ledger account. And all the ledger totals are put here in correct set. Accounts are grouped into categories as well, including first assets, next liabilities, and equity. The correct balances are placed in either the debit or credit column based on the accounting type and activity. The total debits is 6,350, match the total credits, showing the book are generally speaking correct. This trial balance is the final step before the creation of financial statements. It allows us to check if the journals and ledgers are accurate and identify any possible recording mistakes. Here I attached 2 videos that are quite good in showing step-by-step trial balance preparation. There are also exercises I attached using Excel file as well. This one comes from the textbook. It's the Printing Plus Call Limited, which is showing on the learning materials as well. Here I have got one more review question. Which of the following errors would be detected at the point of listing a trial balance? The 4 choices are listed here. The bookkeeper enters a cash sale as a debit of £49 in the cash book and as a credit of 94 in the sales account. The bookkeeper omits a cash sale of £23 from the cash book and from the sales account. 3. The bookkeeper enters cash received of £50 from Peter Jones as a debit in the cash book, but enters the credit of £50 in the ledger account of Roger Jones. The bookkeeper enters a cash sale as a credit of £40 in the cash book and as a debit of £40 in the sale book. The answer is the bookkeeper enters a cash sale as a debit of £49 in the cash book and as a credit of £94 in the sales account. The reason is this is a mathematical error. The debit 49, the credit 94 amount don't match. Finally, some homework also attached. Reading Chapter 3.4, 3.6 of this core textbook. There are also some links showing the resources that students could use for independent studies. So, to summarize what we studied today, we studied how to define what a trial balance is and explain the purpose and importance of a trial balance, identify the position of the trial balance within the accounting cycle, which is the fourth step in bookkeeping, and describe the relationship of the journal, ledger, trial balance, and final financial statements. And we used a couple of examples to practice how to prepare a trial balance using ledger information. There are certain steps that we could follow and follow some of the key principles such as double entry and accounting principles. And we recognize some common types of errors that can be found in trial balance and how to apply different types of techniques to correct those trial balance errors. That concludes our lesson for today. If you have any questions, feel free to send a message here with this video. Thank you for attending today's session. I encourage you to review the materials and practice recording and posting transactions to reinforce your understanding and learning. I look forward to see you in the next session.